Well, I guess we're live now. Out of more YouTube problems, guys. It's a pleasure. It's a pleasure. I just did like a whole thing, a little intro, and it wasn't going anywhere. So that just add that to our list of YouTube problems we've experienced in this week. Jeez. All right. Well, today's Wednesday the 26th. We're going to be looking at hopefully some interesting market moves, but don't have a great feeling like a consolidation day. Gonna take a look at some things that might be influencing the market in this coming week, and then we'll take a look at some charts. Unless things get real crazy today, it's probably gonna be a short episode. Yesterday we hit 6 hours or something. That was a fun one. But yeah, we have our second patron social night tonight, so probably going to keep this brief. I wanted to do a quick run through on moving averages. I kind of like that. Maybe every episode we can take a look at some basic fundamental thing in trading. So chose moving averages for today. So let's get into it. Hopefully we are live. I still don't know. It looks like we are. I probably should double check to make sure it's not hiding us. There we go. Now it shows me live on my own page. Great. All right. So this week, upcoming things that are likely to impact not just crypto, but markets everywhere. Fed Powell, I believe, speaks tomorrow. Thursday. Probably. And also, I think more pressing, Hurricane Laura. The National Hurricane Center is now claiming that Laura will hit Texas and Louisiana as early as tonight as a Category 4 hurricane. That's a big deal. That's some dangerous storming. We're going to see impacts to crude refinery, and certainly for domestic local damage to Texas and Louisiana. There's going to be another hit to those economies. Category 4 is definitely life-threatening. Extreme winds, flash flooding, not something to be taken lightly. So I think it's pretty safe to assume we're going to see some blowback from this. Oil prices are already edging off highs. Gulf of Mexico shut down refineries in preparation. Should be kind of a different end of the week here versus the start. So yeah, all right, I think we are live. Sweet. It's good to see everybody. Welcome. So there's not too much to take a look at today. We had our sell-off yesterday in Bitcoin, and now we're really just moving sideways. I think after yesterday, sideways is welcome. 4 hour looking good. So yesterday during the sell-off, the 4 hour pushed underneath the 200 4-hour moving average. We're going to get into moving averages, but since this morning, so since I even started planning this episode, the 4 hour has taken back the 200. That's a good sign. Typically moving averages, as a rule of thumb, will act as support or resistance, even though they aren't a horizontal resistance nor trend line. They're more of a dynamic price point. So up here and on all of my charts, you'll see a yellow and a green. Yellow will always be 50 and green will always be 200. And those are the inputs of the moving average, just for reference. So 4 hours taking back the 200. The 50 is still curling down. Might be a good target. 11,680. I was looking for 11,800 yesterday for recovery off of this move. Could be a little ambitious. I think the more this 54 hour moving average rolls down and heads down, I think maybe the lower that target's going to be. So currently, 11,682, so just under 11.7. This chart really looks totally different since I started working on this. The last hourly, we had a bullish engulfing. Still in the bullish impulse wave here. And not really seeing too much. So I think I want to take a zoomed out view today. I'm going to look at the monthly. Because I think there was a lot of emotions yesterday, which is understandable. But I think when you're feeling emotional, the best thing to do is to zoom out. You know, that was a high energy time. Even though the fractal said, hey, we're probably looking for lower. We went a little lower than I expected. Probably a little lower than people are comfortable with. But that's going to happen in crypto. That's just the nature of the beast. There really is no other way of putting it. So we have a monthly support at 10.7 down here, off the highs here. If we extend this over, we can see that monthlies are very commonly closing in the 10 area. When we look left, we have June and July right at 10.8, 10.7. March and February 2018, pretty close. They're down a little more at 10.5-ish area, 10.4. So I believe that this will act as a monthly support. Looking up, the candle closes from December 17 and January 18. We'll create our monthly resistance, 13,860. Close enough. Not even sure where these other lines are from. I guess I can hold chart. Oh, I know. So that's our monthly. I think we have a monthly resistance, 13,863, and monthly support down at 10,007. So this whole range is pretty safe. We're above. We have the highest candle close in July 2020 ever since 2017 December. That's the highest monthly candle close, second highest in history. Certainly the highest in recent price action. So that's looking okay. August, still a green candle. Yesterday felt really bad, didn't it? Felt probably terrible for especially new investors who haven't experienced, I don't know, November 18, March 20. Probably didn't feel good. But looking out, zooming back, taking a step back to assess, we see that there's really nothing has really changed. That sell-off really didn't do anything. Our candle is still green on the monthly. It's still, even if it closed here, would again be the second highest monthly close because it's a green candle, slightly higher than July. So let's look at the weekly. Zooming out, we see a weekly resistance at 11,005, which is actually, this is, I guess, testing whether it's support or resistance. I think right now it should be deemed support because it was broken. It was broken, back tested, broken, and it's still ranging here. So I'm gonna say that's support. 11,500. I think we had 11,501. But we can see this support is actually a flipped resistance that was much more powerful than the monthly. We see 1-2 back in February, weekly closes at that same, or weekly opens and closes. Then we see July 2019, same setup. Price moved there and was rejected twice. So this is a strong level. 11,500 is a strong level. We had 1, 2, 3 weekly tests on our chart looking back. And actually, you might even be able to pull this back more. We zoom in. This is 2017, 2018. This is that weekly line we're looking at. We can actually even move this over a little bit to here. 11,518. It's the same price for all intents and purposes. In this case, we see a red candle close on it, a green doji, like open and close on it, and then January 29, we see a candle open and reject off. So this is a serious price level. 1, 2, 3, 4, 5. We see a rejection in February from that level. 5. So 6, we have a rejection in June 24th. 7, 8 candle opens and closes there. 9, 10, August 5th and 12th of 2019. And so here we are again. This price level makes sense. It makes sense that we're not going to just blast through it. It's been a very historical level, at least in the last 3 years, 2 years. So the fact that we've lost some momentum, we've rallied up to here, and now we're pausing, potentially accumulating, potentially distributing, doesn't matter. Makes sense. This is an important level that needs trading. So yesterday's price action doesn't seem that crazy. You know, we're current price 11,479. That's the same price. I mean, 1%, a 1% move is $115 right now. So anything under that is just a negligible. That's really just a negligible amount. 11,479 to 11,518. It's not. It's like 0.5%, maybe even less. So we're basically right here. We're basically right here at this important price level. And price hasn't dumped through it yet. It wicked under yesterday, intraday. But really, where am I doing? Trying to get this visible. Okay, it's visible everywhere. Awesome. But really, the weekly seems pretty good. Seems right where it should be. We're still above this high trend from December 17 to June 29th, or June 24th, 2019. We're still above it. We haven't fallen back in. Falling back in down at 10.5, 10.7, this area, which is what I was saying yesterday when people were panicking, is you can break a sweat under 11,001 or whatever it was. But there's no point of any kind of panic unless we break down into these levels. So at this point, this is nothing. It was spicy. I mean, I liked it because something happened. Boring Bitcoin is worse than Bitcoin going down or up or whatever you don't like. Boring Bitcoin's the worst. So that was a welcomed change of pace. But nothing on the macro scale has changed at all. Like it was really only a sell-off, very, very zoomed in. Let's whip it to the 1 day. Bam. So here we are. Here we are, right underneath our weekly, but still well within the range of looking left at this previous move. Really not that different. The more we zoom in, the more we're able to even see this sell-off. But in the macro, when you zoom out, there's just nothing here. You know, it's like invisible almost. You basically can't even see it. What we would be looking for, because the monthly end, or monthly close, monthly end, is coming up. 5 days. We want to close above monthly support. That seems pretty easy at this point. 10,007. I think we can do that. And ideally, we would like to close this week because the monthly and the weekly are very close together this month. That's not true every month. The weekly closes on Sunday the 30th, and the monthly closes on Monday the 31st. So they're 1 day apart. We want to be looking for a weekly close above 11.5 and a monthly close above 10.7. So in a really weird scenario, just a little brain exercise here, what we could see, and this would be probably not what people want, but what we could see is a weekly close move back up to the 30th, and then we could see the monthly, the last day in August, we could see a sell-off again. And as long as that monthly closes above 10.7, it's all fine. Like it's still good. We will have closed above the monthly support, which is excellent, and a move up to close the weekly above 11.5. We would have a weekly close above support. Everything is just on track. Now, I'm not saying this is going to happen. That's not even my prediction. I'm just saying this scenario that probably wouldn't feel good again would be totally fine. We're still well within the confines of we've been moving up since March, and we still are. If we were to close the monthly under 10.7, that might be a sign that this rally since March could be slowing down, could be reversing. Closing the weekly under 11.5 would be a shorter, not as powerful signal, but still that could suggest that maybe we should be looking for a monthly close below support. But in reality, there's just not that much going on. So I wanted to talk about moving averages today. I'm going to keep it really simple, so I'm only going to have 2. Usually, I personally will use 4. Let me show you what that looks like. I'm not going to confuse everybody with it. Whoa. Change the resolution on the chart today, so it looks a little weird. It's better in this resolution. There we go. Perfect. Typically I'll have more moving averages. So if you have never used moving averages, I would suggest going on TradingView and finding multiple MA. And this is a nice little TradingView hack, because if you have a free version of TradingView, you're limited to 4 maybe indicators. I have a jillion because I pay way too much. But the nice thing about multiple MA is that instead of, and maybe you guys can see this on the left here, these, I'll light one up. They're not lighting up. Okay, so see how this is MA 4800, just ignore the rest of this, but this is moving average. If you're just to select moving average, you only get 1, and that counts as an indicator. So if you wanted 4 moving averages and you have a free account, if you don't use multiple MA, you're going to use all your indicators having individual MAs, and you're not going to be able to have anything else. So don't use that. Search for multiple MA. And what this does is it creates 1 indicator that allows you to have up to 6 moving averages on it. And so what you want to do is click that gear next to multiple MA, and now you can change what inputs, and the inputs are, what is going on? I have too many indicators now. Did it just delete somehow? Somehow I think it just got deleted. What? Yep, I don't know how. Okay. Back on track. So you hit the gear and you'll see inputs and style. So inputs are going to be, you can change these to 1. You can change them to any number. What number you use is really up to personal preference. So a lot of people will use 50 and 200. Those are very common. I personally like to use 25, 50, 100, and 200. And I won't really get into why too much, because I think I'll be bad at explaining it on the fly. But 50 and 200 are very standard. And the nice thing about moving averages is it doesn't matter what time frame you're on. The moving averages adjust to your time frame. A really simple explanation is this 50 MA, yellow one. I recommend always making the same, using the same MAs once you find the one you like. Oh, excuse me. I recommend using the same ones once you find the lengths that you're comfortable with or work with you. And then be consistent with how you color them, how you size them. Lots of people ignore this, but I think it's important because over time, you might not even notice it or realize it, but your brain is picking up on patterns. And by not keeping it consistent, you're making it harder to develop that eye, having an eye for it, you're making it harder to develop like a kind of intuitive sense because your brain isn't recognizing the same things. So I always keep my 50 yellow, my 200 green. You guys can make them any color, whatever you want. So 50 on the 4 hour, actually, let's just take it to 1 hour. So here's how MA is calculated. MA takes the close of the input. So the inputs are over here on that gear, and you can change them. So let's take 50. 50 is the input, meaning it will look at the current candle back 50 candles. So in this instance, the 50 MA is taking all this price data. It's looking at every candle close. So where each of these 50 candle closes, it's adding a point of data. So 1, 2, 3, 4, 5, 6, 7, 8, 9, all the way to here, to the current candle. It's adding them all together and it's dividing them by 50. As a new candle, actually, you know, I should put a box so this is easier to see. As each new candle is created, that's right, just assume that's 50, I think it is. So as each new candle is created, that box is moved over, if that helps you visually understand what's happening. It's dropping the last data point and it's adding the most current data point. And that's what makes the moving averages go up and down. So if we were to look, let's see where it reverses, right here-ish. Okay. So if we were to look right here, we're just looking at the 50. So it's taking this data and right about here on the 50 moving average, we see that it was trending down, and then it began to curl up. So what's that saying? What that is saying is that as we progress forward and drop these candles, so this makes sense. You see these low candles. As we progress forward, we're dropping this data, and that's showing that the average is trending up now, right here on this random red candle. And that is how it's being calculated as it moves forward. So these are something to know about moving averages is they are lagging indicators, as almost everything is. You know, they're not telling you where the next candle is, but what they are telling you is where, instead of looking at each candle, there's a lot of noise. You see lots of small moves up, small moves down, bouncing, whatever. It's simplifying this data. It's removing the noise, it's removing the static, and it's showing you just the average. So why this is useful, or at least why I find it useful, is when you combine it with another moving average. So in this case, the 200. Same thing, but instead of calculating 50, now it's calculating for 200. So the 200 goes all the way back to here. So for the 200 moving average, now it's looking at all of these candles versus the 50, which was only the current ones. So what we can get, or what we can take away from this, is when we see moving averages trending down, that's giving us the idea that the average price action compared to previous, I guess right about here, August 21st is when the 200 started pointing down. It's saying that it's suggesting that momentum, or perhaps the market is has like lost some of its momentum, bullish, and now it's favoring downside. And what's really cool is you see this cross here, August 20th, 2020. We see the 50 moving average moving below the 200. And what this is called a death cross. Don't get hyped on the name. It's really, I wish they called it something else. We should just make up our own name for it, because death cross I think is too emotional. So this is a bearish cross. And the reason is because we see a smaller moving average moving below a larger moving average. The 50 crosses the 200. And that's saying that the last 50 candles average is lower than the last 200. So that's a sign that the market in the recent period of 50 is trending lower than the last 200. That is potentially showing that momentum is going down. And if we look at price action, we can see that it did. Certainly is not 100%, just like everything. This is just another tool in our bag. It's another piece of evidence we can use when trying to take positions. If we look back, we see August 15th, we had the 50 cross up over the 200. That's called a golden cross. I don't like that either because I think it's emotional. Bullish cross, put it that way. And that suggests that the last 50 candles are trending higher than the last 200, so that's a change in momentum. Change in momentum. And as you see, it worked out. Bullish cross happened, price action goes up, got a little overheated, comes back down, bearish cross, and now we're under here. I have known people, and I think mostly those are script bot traders, who have traded literally just this. When an MA, when the 50 crosses the 200, they go short, and when the 50 crosses the 200 up, they go long. I wouldn't recommend it. I don't think it's that profitable, but I do think it works. I think not on the 1 hour. I wouldn't try it on the 1 hour, but maybe on the daily. Maybe on the daily it could be a little more successful. But there are people who just trade that way, and it does work. I think it's just very slow because you can see here on the daily, these crosses are not common. 1, 2, 3, 4 crosses in the last 480 days. So the longer the time period, the longer the candle, so whether it's daily, weekly, monthly, the more you zoom out, the more lagging these become. The slower they are to react to price action and show signals. Because you can see here on March 25th, they crossed, but we had already put in a bottom. So going short on this bearish cross here would have not helped, would have not been a good play technically. But actually, this is kind of interesting. I didn't even know this. So when they did cross March 25th, there actually was a selling period. So that trade actually could have technically worked. But in general, that would have been a bad signal, because going short at 6,900 would not have been that successful long term. I think if you just eye up the chart, you can see that these moving averages are pretty responsive to price. The sell-off in March was a rejection of the 50 daily. The rally in April, this nice rally from 6 to 10, was a break of the 50 moving average, back tested, moved up. So they certainly are in play, and there's something you should be aware of. I'm a huge fan of moving averages when the market is bearish. Not as much when it's bullish. I'm not going to get into why. I think there's just different tools for different times. A rule of thumb, and this isn't a crypto thing, this is like a stock, just trading concept, is when a market is bullish, the 50-day moving average is what should be considered the dip. So in a bullish market, yes, price does come down under the 50, but that is where many traders look to buy the dip. Currently, the 50 daily moving average is right at our monthly support. Surprise, surprise. That should offer a good amount of extra support there. So that's actually a good sign. I didn't even see that before this. $40 off. So yeah, moving averages lag. So there's something that people use in attempt to remedy this lagging. I don't. I like regular moving averages, but most traders, I think that's safe to say, most traders actually use what's called an exponential moving average. And so exponential moving average is a little less lagging, and it does it by altering the formula or the equation for calculating at what price these should be. Moving average, like we said, is you count all the closes in the time period or the input. The input is just the time period. And then you divide it by the input, so you're just getting an average. So the last 50 candle closes added together, divided by 50, that's where it is. Exponential moving average changes that formula up by weighting, and I'm not gonna explain this in anything other than these terms. It does it by weighting each candle instead of treating them equally by dividing by 50. It gives more value or more weight to each candle the closer it is to current. And what this achieves is a more reactive moving average. So we can see here, this is October 2019. We had a bearish cross. We did get a sell-off. As soon as price moved above the 50 EMA, we had the high in October. The cross was lagging. This was a huge trap. And then here, January 2020, on January 21, we had the bullish cross again, and we saw a rally. So that was a good bullish signal. Price fell below the 50 EMA, rejected again, had a bearish cross. So here's the cool part, is if you remember from a second ago, the 5200 bearish cross on the moving average, not the EMA, which is what we're looking at now, was right about here. And I said, what was it here? It was right there. My bad. It was right about here. And I said, that's okay, because you did get a little bit of a good signal here, but overall it was bad. What's cool is the EMA did react here. This is a perfect example. I didn't even plan this. We see that bearish cross right here, March 12th. This bearish cross could have signaled you that short was the right play, right here. As soon as those crossed under, huge sell-off. So the EMAs are built to be more responsive and to lag less. But still, if you look, price is very reactive. Price is very attracted to it. My observation, and I haven't really heard this elsewhere, so I don't know if this is like what other people think, is that price is always seeking moving averages, and it really doesn't matter what the inputs are. Price is always seeking the moving averages, and moving averages are always seeking the price. So they're always trying to come together. And that is the mindset I use when trying to use these tools to trade, is that there's always a statistically good chance that either the moving average is coming up to price or price is coming down to the moving average. And so in this example, I'm switched back to regular MAs, not EMA. We see 50 coming up to price, and price not really reaching down to the moving average. So this is coming up slowly. And what I would expect if I'm not using anything other than moving averages to trade or think right now, is that this 50 will keep moving up, and price is likely to move sideways until it gets there. We might see a dip below it, because as we said, under the 50 daily in a bullish market is considered a good buy, or is buying the dip, so we could see a wick. But then I think price is likely to reject off of it and move back up. The 200 is very slow in the daily, so this thing's just trucking. But what's nice about the 200 is that eventually price will meet it again. For sure. You can see if we look back to the previous bull run, we see dip opportunities under the 50. So we have this. That was a good dip. We have this here, which would have been a little rougher, but we see a touch to the 200. So price always wants to go there. You'll see that on the way up, it touches the 200 multiple times. And when it does, it is a huge buying signal. Almost every single time. As soon as the 200 here was broken, back in February 2018, we see that the 200 is broken and we see candle closes below it. That should have been a good indication. I mean, hindsight's 2020. Good indication that the market might not be as bullish as it was. And that would, we see the first bearish cross here. And that did. It signaled us, look at it, they never crossed again until like April 1st, 2019. So while the 50 is under the 200, in most cases, and there are fake outs, but in most cases that means the market is trending down. And when the 50 is above the 200, in most cases, and this is on the daily, don't do this on the 1 minute, you can still use these moving averages, but you're not going to get a macro. You're not going to get macro anything. On the daily then, when the 50 is above the 200, typically the market's trending up. These are great basic tools that I think everyone should look into, especially new traders, because they're very easy. And I think what they do is they're great for training your mind to get in that trading mindset. So see, back to the 1 hour, the 50 moving average, price hit it, and now is wicking down. So it acted as, it met this, this is the weekly, so it met this weekly price line and acted as resistance, at least so far. So I think that's pretty much it. EMA versus MA, moving average versus exponential moving average. There are other types, we're not going to get into them today, other types of moving averages, such as Hall moving average, smooth moving average. I'm sure there's others. But the reason, another reason I think that it's really important, especially if you're getting into this now, to start using moving averages, even if you don't forever, is because every indicator, with the exception of, I mean, I can name like one or two. Every indicator is honestly just telling you what this moving average data is telling you. It's just displaying it in a different format. So the MACD even, I removed those lines. I don't like them on the MACD. But for example, to back up what I was just saying, is on the MACD we see these crazy lines, right? These are actually just the 12 and 24 EMAs. So really, we're just looking at MAs here again. And that's how every single indicator, with the exception of, there's certain ones that are like hash ribbon, things that are looking at data that isn't price data. Ichimoku is one as well, because it's not actually using moving averages, but it is still, all indicators are using the same data that are reporting on price, because that's the only data that exists, is the price. Ichimoku does different stuff with taking highs and lows over certain time periods. But anyway, that's why if you ever hear anyone saying like, oh, MAs aren't good or something's not good, all indicators are really just telling you, they're just reporting to you the same data in a different format. And all of that data, if you want to break it down, is just moving averages. That's really all there is to it. So yeah, I hope that was useful. Little morning lesson for everybody. How far into it? Oh, we've got 185 viewing. I haven't even looked up